All right, welcome back. This is our second part of international capital budgeting. So in the previous section, we looked at domestic capital budgeting and started from an accounting-based net income approach and kind of broke it down and ended up with an adjusted present value model where the value from a project was coming from a few key sources. It was the tax-adjusted operating cash flows, the tax benefit of depreciation, the tax benefit of interest, and then the value at termination. And then subtracting from value was initial setup costs. Right? So now we have to bring this into an international context, and that means adding, some complexity. Right? We have basically major components are the fact that exchange rates are going to be relevant, that we have to, assuming we can repatriate income back to the parent, that income will be denominated in the local currency. And then also there are a couple features of international investment that become relevant to NPV. So we're just going to go through these one at a time. So if you remember right before, so terms we recognize from before, you can see here's the operating cash flow term, here's the depreciation tax shield term, here's our interest tax shield term, here's our terminal value term. So we've got some new terms here. So here are 4 new terms, and then you'll notice these S bars everywhere. So we'll start with S bar and then work our way through. So what is this? So S bar is the expected spot rate at time, T, or I indexing 1 to T. This should be T, right? So I guess it could be currency I at time T. Anyway, point being, if I'm a United States parent and I have a subsidiary operating in Thailand, I have my operating cash flow going here, right? I've got operating cash flow. I'm generating it in Thailand. And so I need to exchange my Thai baht for dollars to bring it back to the parent. And that's going to have some particular exchange rate next year. And it'll have a different exchange rate the year after that, and a different exchange rate the year after that. And so on, right? So we need to do this, we have to have an anticipated exchange rate picture over time. Right? How do we expect the exchange rate between the two currencies to drift over time? And so if we have that, right, then we just go ahead and do this multiplication and just go. Right? So you can say, okay, what if, so if it's 40 baht to the dollar this year and 39 baht the year after and 38 baht and 37 baht, and then the project's done, then that would be those S bars, right? It would be 40, do the whole thing. 39, do the whole thing. 38, do the whole thing, right? With this adjusting to, right? So, conceptually, it's pretty simple. We're just taking, is this the year 2 operating cash flow? Okay. Translate the Thai baht operating cash flow to American dollars using the year 2 expected future exchange rate. We have to do that for operating cash on an interest adjusted basis. We have to do it on the depreciation tax shield, right? On an interest adjusted basis. We have to do it on the interest tax shield on an interest adjusted basis. And then we have to do it for the terminal value on an interest adjusted basis. Okay, so we have, so basically if this project lived for 4 years, we'd have 4 of these and 4 of these and 4 of these and 1 of those, right? So we'd have 17 terms. That's why you do these in Excel, right? You're adding up. It's just like you're adding up a ton of stuff. So having a spreadsheet program is really useful for that. So at this point, all we've done is take the domestic APV and just throw in these exchange rate terms, okay? So down here, these are some additional, well, I guess, so this one is the domestic term too, but these are additional because of a nature of international investing. So let's start with this one. This was already here, right? Minus C0, that's an initial cost. We, though, are translating those initial costs at the present exchange rate, right? So if this is an investment in Thailand, we will need to take dollars, buy the Thai currency to then spend baht in Thailand to buy the stuff we need to set it up. Right, so we'll start with that. And then we've got these other terms. Okay, so what is this? So these are restricted funds, right? These are restricted funds. They're money that we couldn't get access to. It was stuck in our international subsidiary, right? And again, could be a country with capital controls. It's like, look, we don't let you take money out of the country. It's like, oh, okay, so I've got profit, but it's just stuck over there. So if I invest in this project, then I can get that money unstuck, and so that has value, right? So we'll get it unstuck at the current exchange rate, and that'll be great, right? So that'll add value. I think this overstates this, right? In the sense that restricted funds typically aren't restricted forever, and you'll have other opportunities to maybe bring restricted funds home. So this should really actually probably just be, well, what's the expected number of years you save until the restricted funds are released? And that would be, and the interest adjustment would be the value, but it's fine. I mean, if this makes perfect sense if your assumption is that these restricted funds will never leave this country ever and be of use, never be of usefulness to the parent unless we do this. Okay. And in that case, it makes sense. Pull them out, use the spot exchange rate, and it's just added value. These last two terms have to do with a situation that's common. This is a commissary loan. That's why it's CL. The idea is a lot of international countries want to support. They see foreign direct investment as a way to stimulate their local economy, and so they want to subsidize foreign investment by providing below market rate loans. So and this is just like a common thing that happens. I mean, we do this in the United States too, right? I mean, if you follow Wisconsin politics, there was a whole thing with Foxconn building a plant in Wisconsin, and there was a bunch of incentives, directed towards Foxconn to get them to come to Wisconsin. So this is a common situation. So how do we handle it? Basically, the idea is you treat the value of the commissary loan as itself as value, right? So the total value of the loan, the total proceeds of the loan is just straight value. And then we subtract off the payments on the loan, right? The payments on the loan on an exchange adjusted and interest adjusted basis. So if you think about a normal loan, right? If I borrow at market rate of interest, I'm getting a bunch of money, right? And then I'm making a bunch of payments. And on an interest adjusted basis, that interest will add up to the loan. Like, that's the whole point, right? If I borrow, 20 grand to buy a car, and I end up paying $26,000 over the life of my loan, that's fine because I also got to pay later, and that is worth something to me, right? And if we took all of those interest payments I paid and used the interest adjusting factor, you end up with exactly 20 grand because that's how they came up with what the payments would be in the first place, right? So for normal loans, there's no reason to include these terms because they will totally cancel. Right now I should restate that. For domestic loans, they totally cancel, right? Because this S and this S is the same S, so they're irrelevant. And these are designed to actually be this, so it just all goes away, right? But now we're talking about a situation internationally where they're deliberately giving you a cheap interest rate, right? So it's like, okay, well then this is going to add up to less than this by, a significant margin. And so other than the exchange rate situation, this should come out as, positive. One thing to note, though, is that if the exchange rates are drifting, right, it could be, especially if you're thinking about, okay, I have to make the payment in the foreign currency, and if the foreign currency is appreciating relative to the domestic currency, my effective interest payments on this loan are going up and up and up every year consistently, and I can plan on that, right? So it could totally be true that despite the fact this is a commissary loan with a favorable interest rate, the unfavorable future expected exchange rate drift can negate that effect and more. But that's not usually how this works, right? You get a commissary loan with a favorable interest rate, and then the exchange rate is often favorable, right? In the sense that you're paying currency, a local currency, which tends to have a higher inflation rate than the stable currency that the parent usually operates from. I mean, there's exceptions to that, but that would be sort of the normal situation. In which case, this S helps even more. So that's the international adjusted present value model. So Lessard's APV model. And so this is just a review of all of that breakdown I just mentioned. So this is a comment about borrowing capacity. And in general, right, when we have more stuff, we have more borrowing capacity. So it's not quite correct to think, well, what's the borrowing capacity of the current firm? If I borrow up to that capacity and invest in this project, that's the most I can do because, that capacity will then have increased. And if the value that you've created is recognized, it could even be beyond that. But anyway, that's not that important. Really, the idea is about doing positive NPV projects. It's just that, NPV is this Lessard's APV with a whole bunch of pieces in it, right? So, so a big benefit of APV is the fact that it incorporate all these difficult to handle cash flow terms like this coming from all over the place, but because we have a place for everything, you can sort of break it down and do, right, like I can say, okay, well, what is my depreciation and what is my tax rate, and just sort of trust the process and not have to try to carefully reinvent the wheel all the time. If we think about APV, right, positive APV means do it, negative APV means don't. If you think, and a lot of these like sort of subtle foreign cash flow points are positive, right? So this commissary loan factor, that's going to generally be positive, and the restricted funds, that's generally going to be positive. So what that means, right, is that an analyst doesn't have to do all of this necessarily, right? They could just do the standard domestic model with the expected exchange rate adjustment. And if APV is positive, then it's just good, right? Just, okay, APV is positive. We've got the green light to do this. I don't need to try to do all that, right? But if APV is negative, but only slightly negative, then it can be like, okay, well, APV is slightly negative, but look, we're going to get access to restricted funds. We're also going to have access to this commissary loan. So then that becomes part of the overall package. But I guess the point being, you have this sort of extra work you do on an international project, but you only need to do that if the APV is negative. If it's positive, it's only going to get better, right? For the most part, except for that, really strange scenario where you have an appreciating international currency. So we do the work now. A key component to all of this, like a very important component, is this expected future spot rate. So where does that even come from? So that if you think about all of the work we did last chapter with the the foreign exchange market stuff. We have these international parity relationships that drive how currencies relate to each other over time. So we're just going to lean on that. So this is a purchasing power parity assumption, and it's just the presumption that over time the difference in inflation, right, or inflation expectations are going to drive the changes in the exchange rate, right? And we know, purchasing power parity is not like it doesn't, things that you can do with forwards tend to have tight arbitrage bounds and work very closely. This is not that, right? So purchasing power parity is, I guess it's probably, reasonably accurate for the long term. It can definitely be inaccurate in the short term, but it's a good first cut to think about how to do this, right? So we just sort of say, okay, well, my domestic currency has an inflation rate of 2%. The international currency has an inflation rate of 8%. So we would expect a 6%. Now that's not totally accurate because this is multiplication and not addition, but you get approximately 6% change every year, right? In that. And so you could just start with the current exchange rate and then do that 6% drift every year. Right, and in this case, we'd have 1.02 divided by 1.08 and over and over and over again. And so that would be a number less than 1. So then this is shrinking. So this all works under also, unfortunately, an assumption that the project in question is roughly equivalently risky to the firm generally. And that's not always the case, right? So it could be that right? So, you can think about, a firm that's launching a new type of business as well as a new location, right? In that case, then you're dealing with a different risk level. And the way to handle that is increasing the interest rate is really the best way. So doing a risk-adjusted discount method. And probably the best way to do that is to think about, usually on an industry basis, you say, okay, we're, our current business is kind of, focused on like consumables, and we're tiptoeing into consumer durables. And so maybe we'll go look at the consumer, a set of companies that do consumer durables and look at what kind of, cost of capital they report. A lot of firms will report their cost of capital in their proxy statements and investor materials. Not always, and you can also sort of back out to what they're using sometimes. So that's a way to do it, just to say, oh, well, we're doing a thing that's different from our stuff, so let's just look at the other companies that do things like what we're about to do and use their discount rate instead of our discount rate. And that's important because otherwise, right, because what can happen is if you don't risk adjust it, what happens? So you have your discount rate that you've been utilizing, and then you're investigating possible future projects. But you use the same discount rate for all the projects. So the ones that are riskier will tend to bubble up as having higher NPVs than the ones that are safer, right? Like think about your competitors. They passed on it because it was negative NPV because they correctly adjusted for risk. But you did not. So it looks good to you, so you're going to do it. And the safe one that your other competitors jumped on because it was worth a lot, you passed on because it looked negative NPV to you because you were applying an interest rate that was too high. So then what happens? You're accumulating these projects that are riskier and riskier. And so when you try to go get financing, they're charging you more and more financing. So you would experience, the organization would experience, oh, wow, like it's getting more and more expensive for us to raise capital and we don't know why. Well, it's because you keep adopting these risky projects without properly adjusting, right? So it is important to do a risk adjustment measure. And doing an industry comparison is probably the best way to do it. Your book talks about a certainty equivalent method, but also, suggests that it's inferior to the factor method. I agree. Like this is very difficult to try to imagine how to implement this effectively, and the discount method works just fine. A last sort of thing we can think about is a sensitivity analysis. So sensitivity analysis is where you would take different scenarios, right? So you have your APV, you run all the stuff in the APV, you get an APV number, but then you redo the analysis with with different revenues or different expenses. Let it drift a little bit and see what is the overall effect. And then what if you're doing this really sophisticated, you'll do a Monte Carlo approach where you say, okay, I'm going to randomize all of these things, and then do it a million times and look at the distribution of outcomes, right? What percentage of the time am I a positive APV project given the randomness inherent in what I'm trying to do, right? And it could be like, oh, this project is only positive APV 55% of the time. So it's positive, but it's not consistently positive. And that might mean, oh, well, shoot, maybe this might be too risky to pursue, even though it's positive APV, because it's too sensitive to the inputs, right? Where you can get something that's, 98% of the time we get positive APV. So we're not super sure about exactly how positive it is, but it's going to be almost definitely some kind of positive. So we can do a really simple version of that. So purchasing power parity assumption. So APV that we've talked about assumes PPP holds, and that's common, but so I guess if you have right, there's a scenario where, like, again, so we're assuming PPP holds and the exchange rates drift according to PPP terms, and if purchasing power parity always holds and we have no difference in tax rates, it doesn't matter. We don't need the currency adjusting doesn't matter, because you can kind of say, oh wait, I convert from 1 to 39 and I can buy 39 Big Macs, or I convert from 39 to 1, but I can buy 39 Big Macs because Big Macs are only 2 cents or whatever, right? It's just kind of like you can get the same amount of stuff either way. The translation doesn't matter. And so in the special case, when you have the same taxes and the same purchasing power throughout, then the whole international thing doesn't really matter. You could have just done it domestically and it would have given you accurate data. So that's sort of important to recognize, that actually the currency translation really matters for taxes, right? So taxes are a primary driver because they have different tax rates. And then to the degree that currency exchange rates don't stick with purchasing power parity, then that's going to lead to a difference. Okay, so what this is looking at is, this is the we want to do an example of this APV, but which we'll just do that in a separate video. Another important thing that comes up is real options. Now, we're not going to do quantitative real options in this class very much. We'll do it's so what we could do is just have right, if you can imagine having a calculator where you feed it in, but that's just probably not really going to be that helpful. So we're not going to do this numerically, but conceptually we can talk about it. So what's the deal here? So the idea here is, when we say real options, these are actually options in the Robinhood investment sense, like a thing you can buy that behaves a certain way. So an option is a derivative instrument where, something like, okay, the stock is trading for 400. I'm going to pay $7 for a coupon that lets me pay 410 for this stock no matter what. Right? So right now I wouldn't use that because I can just buy it for 400. But what if the stock goes up? Right? If the stock goes up to 430, now my 410 is looking really good. I can make a $20 profit. So the idea with an option there, right, is that you have sort of this scenario, this thing, where it's like, okay, if things go well, right, that's a big if. So right now this is worthless, but if things go well, suddenly this thing that's worthless will become worth a lot. And so the fact that it probabilistically is worth something means it's definitely worth less than something, but still something now, right? So again, you could say, well, if this drifts off, it's worth 20. I don't know if it's going to drift up, but maybe I'll pay 5 for it because it has a chance to get to 20. Okay, so that's what that is in the context of an actual traded security, unlike a stock. In projects, right? So actual physical projects often come with real options baked into them naturally. So a good example is, okay, so let's say, I'm launching a Snickers energy bar. That's the example I used to always use. I launched the Snickers energy bar, and we sell it, and it does great. And we have a positive APV. We win. We're done. Or we launch the Snickers energy bar, and actually it's super great, way better than we thought. And so we're not just making more money on the energy bar, but actually we can do the project kind of again at a bigger scale and make even more, right? So you don't just have to stick with the original scale that it was launched with. And that would mean that maybe the Snickers energy bar is slightly negative APV at launch, but it has this real potential to blow up big. And so there's, a 30% chance that you have this really positive APV project that you can then launch. So it's like, well, okay, I'm going to spend the $500,000 to get the chance at 30 million sometimes. So a growth option is a thing that happens. And also you like a shutdown option where you can say, okay, well, if this is losing money, I'm going to kill it and reallocate those resources to something else. That can help the APV as well. It's like, okay, the fact that I can bail on this has a lot of value too. So, so timing, right? And sometimes it can be, well, I'm just going to wait, right? The best thing to do is to do nothing. And so and maybe, right? So maybe this thing is negative APV now, but I can wait and there's a chance it will go even more negative APV or it will go positive APV. And so it makes sense to invest a little bit to wait. So a good example would be for that, if you think, I guess a classic example is like in the semiconductor industry, they have to build these fabs or like a fabricating facility where there's tons of specialized equipment. And you don't know, right? Is it time to build a fab or not time to build a fab? It kind of depends on what your competitors are doing and all that kind of stuff, right? So, and the build out of the fab is really expensive and takes time. So it can make sense from the perspective of a chip manufacturer to say, okay, we are going to build the building, right? So we'll have a big fab building that's going to happen this year. And at the end of this year, we'll have a big fab building. And what happens at that point might be, and it sits there, right? So having a big empty fab building ready to go can be, pretty cheap relative to a fab, right? So you have a cheap building that's just sitting there. And then, but what is it giving you? It's giving you, okay, if I actually choose to build a fab, I don't have to wait for the building to finish. So it gives me more flexibility. I can get to the market faster. And so, right, maybe I just always have an empty fab factory sitting around so that I can pull the trigger and get up to speed as fast as possible when it's time, right? So that would be a timing option where it actually does cost money, right? It does cost money to build that empty building and to maintain it. You got to hire some security guards and pay interest on it. But it's not that expensive, right? It's just 4 walls and a roof. And, so you pay a little bit of money and then for the option to accelerate a chip launch by a lot, right? So those are all kinds of real options that can occur. And real options are really important to capital budgeting in the sense that often companies will adopt slightly negative APV projects because they know that they do the math on some real options that are very valuable. So it's kind of purchasing these growth options that are really good. And then you've got sort of stuff on, you've got stuff on the table all the time. Sort of an irons in the fire kind of situation. Okay, so in this, so here's an example. So we've got, so let's say that there's this, right, the sales forecast for this company ends up under what they were thinking, and APV is negative at that lower rate, and then you do the exchange rates. And so, depending on the European Central Bank's monetary policy, we're going to get different exchange rates. So we have a positive APV and a restrictive monetary policy, and a negative APV and an expansionary monetary policy. And so, right, so if they commit now, they're gonna they have a chance. And what if this is just a 50-50 chance, or if this is a 50-50 chance, it's like, okay, we got a 50% chance of making the 86 million and a 50% chance of losing 186 million. Well, that's bad, right? That's not a good idea. But, right, if we wait a year, then we'll know which of these two is true, right? If it's expansionary, then we know not to do it. If it's restrictive, then we'll know to do it. And so we would like to be able to hang out and just launch it if it's good, okay? So that's what they want to do. But, right, to do that, though, they have to, lock up the land. So this company, right? This company is buying land in Zaragoza to build the facility, and then they pay the landowner a fee. Or it's not even a purchase; it's just a purchase option. It's like we're sort of saying, "Hey, we want to pay you for the option to buy this land? Maybe lock in a price." So they pay, 5,000 euros to have the land in place if they choose to go for it. And again, you can see how this math would math out. I've got this thing. I haven't done it yet. The sales forecast came in poor, so it doesn't really work to just do it. We can't just pull the trigger. And we have some uncertainty about the exchange rates. And so again, because if it made sense to do it no matter what, we would just do it. So because this is on the boundary, right? It's on the boundary. It needs it needs a tailwind to make sense. And one potential tailwind is a favorable exchange rate regime, right? So if exchange rates move in a way that benefits us, suddenly this works, okay? So then we say, all right, we are going to do a purchase option on this land so that if this works, right? If things drift in our favor, then we'll go. Then we'll pull the trigger, right? And if they don't, right, this was a marginal project. If they move away from us, it will go to not even marginal. It'll be very negative, and then we just don't do it. And what are we out? We're out the 5,000 euros we paid for the purchase option, right? So you pay 5,000 euros or 5 million euros for a purchase option for a chance to get an $86 million APV. And that makes sense, right? That math makes sense. It's really obviously so. right? It's like, if you had a $5 scratch ticket that had a half chance of being an $86 ticket, you bet you'd do that, right? Of course you'd do that. So that's kind of the situation. And so you'll get this comes up a lot. And also you can think, and we've seen this too, right? You might have like a parcel of downtown real estate that's just sitting empty. Well, that can actually make a lot of sense for a while in that, there's different things that could go there. And so maybe you wait until you know for sure what's the best thing. We're not going to do this, but you can use option pricing methods to figure out, right? You can kind of see how this works, where this isn't a true probability. It's a risk neutral probability, but you get this sort of like if we have a 52% chance of getting the good outcome, we have to interest adjust that back to now. But you end up with, all right, so like the good scenario gives me 41 million probability adjusted, right? I get 86 half the time, so it's like 41 million. Would I pay 6.6 million to get 41 million? Yeah, I would, right? So buy the purchase option on the land, see what happens, and then you don't have to cry about it if the central bank goes expansionary and it doesn't make sense. Okay, so in the next section, I'll go through an example of using the APV method to do some capital budgeting.